What we're going to discuss today is some of the things that the new concepts and new ideas that we're going to cover in Chapter 5. So we're going to start off with definitions, and then we will go to problems that we're going to work. Chapter 5 specifically covers inventory costing and other issues. At the top of this, you'll see inventories and cost of goods and cost of sales for Chapter 5 is the topic. Goods in transit. As we discussed in Chapter 4's video, FOB destination and FOB shipping point have definitive results on your inventory, cost of goods sold, and your company's expenses. I will refer you to Chapter 4's video or to the definitions on page 210 for further explanation. The effects of FOB destination or FOB shipping point on your inventory are important and are most assuredly testable. Freight on board destination or free on board destination is the buyer assumes responsibility for it and ownership for it as soon as it is loaded onto the delivery truck from the seller. The buyer has all the liability and ownership from when it is taken and loaded onto the truck from the seller. Any cost incurred for that freight on board destination or free on board destination is incurred and goes into your cost of goods sold and your merchandise inventory account. So there's a definite effect on your inventory and your cost of goods sold for merchandising. Free on board shipping point, the seller has responsibility until it lands at the buyer's point of destination. What that means is that the seller has all responsibility for the inventory for the entire time it's in transit until it is delivered to the seller's place of business and or home. What that means, though, is that any costs incurred for shipping that has to be expensed immediately in the period in which they occurred for selling that item and then shipping it to the buyer. Goods on consignment. There's a very good definition for this on page 210 of your text. However, to break it down to its most basic level, if you own the merchandise and you send it to be sold on a consignment basis by another company, you still own it, you are still responsible for it on your inventory and in every other legal aspect of financial statement preparation. You are responsible for it. Goods damaged or obsolete. Damaged and obsolete, also deteriorated or spoiled goods as well. Goods are not counted in inventory if they cannot be sold. These are expensed to cost of goods sold or some other loss method immediately in the period in which they occur. However, there is a category for goods damaged or obsolete called net realizable value that if they may be able to be sold at a reduced price, they are included in inventory at a price that is they are included in inventory at a price for the reduction. That's what net realizable value is. Sales price, and this is the formula. Sales price minus the cost of making the, of making the sale. This loss in value as above is measured in the period in which it occurred. Let's talk about inventory cost flow assumptions. We first have FIFO, we have LIFO, weighted average, and specific identification. Each one of these has a very specific method of being used. I will do some problems in Excel. I made the problem up myself, so you're not going to find it in your book. You'll just have to look at what I've got on the Excel sheet. FIFO, first in, first out. As an inventory cost flow assumption, it means the first goods in are the first goods out and helps ensure cost flow in the order which they are occurred. LIFO. LIFO is one that most businesses prefer to use because it does have a tax advantage, but we'll discuss that some more. LIFO is last in, first out. As an inventory cost flow assumption, it means the last goods in are the first ones out. Costs flow in the reverse order in which they were incurred. This method is used by many businesses because in a period of rising cost, inflationary, or just rising cost, it most closely matches the expenses used to obtain that inventory. I have this underlined. This is really important. If I have it underlined or I have it in bold, it's really important to know this. LIFO has a favorable tax effect on net income, and thus the IRS requires that if you use LIFO for tax purposes, you must also use it for the preparation of your financial statements. This is known as the LIFO conformity rule. Please pay special attention to this. This is a testable question. Weighted average assumes that the costs flow at an average of the costs available. If you have 100 items of all different prices, you take those 100 items and their prices and you average out what the cost is over the 100, and then you use that for each one of them. So if you have 100, or let's say 10, you got 1, 2, 3, 4, 5, 6, 7, 8, 9, $10 for, you paid $1 for the first one, $2 for the second one, so on and so forth. You would take the average of that, which is 15, 20, 45, 55. So you would divide that by 10 and you'd have a 5.5. I believe it's, I'm doing this math in my head, so don't hold me to it. But you would take the weighted average of all of the items, and that would be what weighted average means. I do go over this further in the Excel spreadsheet. Specific identification assumes that each piece of inventory can be specifically identified, and thus its cost flows can be specifically identified as they are incurred. This is typically used on items with a high dollar value because it's not really cost beneficial to say it cost me a penny to make every one of these nails. I'm going to identify each nail with a number and then what it cost me. Nails, not so much. Cars, yes. Cars have a specific identification through their VIN number, so you can make a matching inventory system that matches the inventory to the cost you incurred when you bought it. Again, I go over this in greater detail on the Excel spreadsheet. I'm going to scroll this now. I'm going to go to the next couple of items on here. Consistency concept prescribes that a company use the same accounting method period to period. So if you use LIFO to do your inventory, you have to use that from period to period for your financial statements so that they are comparable across periods. The exception to this is when a change from one method, such as from LIFO to FIFO, will improve its financial statements. What that means is that if I switch from this cost method to this cost method assumption, it's going to more closely approximate how I spend my money. A great example is, say you have a oil well or a coal mine. Let's use that. Natural resource. You're not going to dig down to the bottom to get the very first bucket that came out of the coal mine. You're most likely just going to scoop it from the top. But let's say, for argument's sake, you were using FIFO to keep up with your depletion of your coal from your coal mine. As each bucket is taken from the bottom of the pile, that's not going to closely match your expenses. However, taking it from the top of the pile, which is last in, first out, would match your cost flow assumptions perfectly, so it would make perfect sense to change from FIFO to LIFO in a way that would more closely approximate the depletion of your natural resource. The consistency concept does not require that one method be used exclusively. It can use different valuation methods for different categories. So say you make 15 products. One of them happens to be coal, and then the other one happens to be some byproduct of coal. You might want to keep track of the cost of the coal by LIFO, and you might want to keep the cost of the byproduct by the first in, first out. Those are different categories, so you can use different methods. Please do not get confused on this. Make sure that if you're getting confused, stop, read this again, and understand that, again, with the consistency concept prescribes that a company use the same accounting method period to period so that financial statements are comparable across periods. The exception to this is when a change from one method to another will improve its financial statements. Full disclosure of the changes must be reported in the notes of the relevant sections of the affected financial statements. But the consistency concept does not require that any one method be used exclusively over the other. And then we have one final one that I want to go over, which is the lower of cost or market. This is a tricky one, and people get this wrong a lot of times on tests. So I want you to make sure you pay attention. And if you get confused, stop, reread this. Lower of cost or market. Accounting principles require that inventory be reported at the market value cost of replacing inventory when market value is lower than the cost to acquire it, which is also known as the historical cost. We always keep everything at historical cost. Unless historical cost and you have a lower than cost or market and your historical cost is higher than what it would cost to replace it, you then have to adjust it downwards to make up for that lower market price. You never, ever, never appreciate a merchandise inventory. It never goes up. So you can't sit here and go, well, I bought this at $5, now it's worth $10. I'm going to account for this now at $10. Merchandise inventory never appreciates. It always is either the lower of the cost to acquire or market. And that means that what you paid for, and I do go over this in Excel in a few moments, so it will become a little clearer to you. You only take you only depreciate here. You do not, and I do not mean depreciate as in depreciation. I just mean it as in it loses value if the market price is lower than the historical cost price. Is lower than the cost to acquire if historical cost is what? If this happens, you have to debit cost of goods sold and credit merchandise inventory for the price differential. This has the effect of raising your cost of goods sold and lowering the value of your merchandising inventory if replacement cost is lower than what it cost you to acquire it. No adjusting entry is made. And reread that. If replacement cost is lower than what the historical cost to acquire it was, no adjusting entry is made. And down here I have some items highlighted with stars. Merchandise inventory cannot appreciate in value. The purpose of the lower of cost or market is that inventory must be held at its historical cost or its value must be lowered if its market value to acquire is lower than it cost for you to buy it in the first place. Okay, I want to make sure we're very clear on that. All right, I'm going to change over to the Excel spreadsheet. Okay, these are numbers that I just kind of made up for myself. And I duplicated them all the way down till specific identification, because specific identification has a little different issues involved with it. So here we have FIFO, very top. Beginning inventory, we're gonna call it torque wrenches. On August 1, we have 10 of them. They cost us $15. On August 15th, we bought 10 more, and we had at 20, it's what we had to spend was $20. On the 22nd, we actually sell 15 of them. So under FIFO, we're gonna take the 10 at 15, and then we're gonna take 5 more from the 20 to give us a total cost of sales on that of $250. 10 times 15 is 150, 5 times 20 is 100. That gives you your $250 total cost of sales for that. Your ending inventory balance would be 5 torque wrenches at a cost of $20, leaving you a ending inventory total cost value of $100. This is under FIFO. First in, first out. The next one we're going to do, we're going to talk about LIFO. Same exact circumstances. August 1, beginning inventory, 10 torque wrenches, cost us $15. August 15th, we bought 10 more at $20. And on August 22nd, we sold 15. Now this time you'll notice the price is different because that is, we're going last in, first out. So we're going to take the cost of the total 10 of the $20 units and then 5 of the $15 units. So 10 times 20 is 200. 5 times 15 is 75. That gives you a total cost of $275. Now in this circumstance, your ending inventory is going to be 5 of the $15 wrenches from beginning inventory because we're going last in, first out. So that leaves you with an ending inventory value of $75. Okay? On weighted average, beginning inventory, August 1, we have 10 torque wrenches at a cost of $15 per unit. We buy 10 more on August 15th. And we paid $20 a piece for those. On the 22nd, we sold 15. What we did is we took the 10 times $20 is $200, and the 10 times 15 is 150 for a total of $350 of inventory. You sold 15 of them at $17.50. You have total cost of sales was $262.50. And over here, your ending inventory with the weighted average is 5 units left at $17.50 because that's the price we came up with from weighted average. That means our inventory is worth $87.50. In all 3 of these previous ones, every time the total cost always ends up to be $350 of inventory. $260 here, what's remaining? It's all $350. If you add that, if you add the $275 and the $75, if you add the $250 and the $100, because that reflects, the only thing that this reflects is the change in methodology, specific identification. Now this is the tricky one, so I've wrote it out here in a way that hopefully will enable me to do this easier for you. I'm going to have to get out of the picture so I can control the mouse for this. Well, I'm going to be fairly close to it, but okay. So on August 1, we have 5 cars. This one cost us $4,123. This car cost us $5,132, and I'm making all of these numbers up, but they do stay consistent. Car 3 cost $4,111. Car 4 cost $4,222. Car 5 cost us $7,700. So our total inventory cost available for sale right now is $25,880. On August 15th, we bought 5 more cars. Car 6, $35.87. Car 7, $54.87. Car 8, $65.21. Car 9, $54.62. Car 10, $35.92. So now we have total, for these five new cars we bought, we spent $24,626. This gives us inventory available for sale of $49,914. Now on the 22nd, I'm going to scroll that up a bit, we sold car 1, car 2, car 5, car 7, car 9, and car 10, leaving us with cars 3, 4, 6, and 8. The cost of those cars, if you will pay attention here, I'm highlighting, I'm going to go up here and change the color here because I hit it, is the same as what it would have cost us. Car 1, $41.23, car 2, $51.32, car 5, $7,700, car 7, $54.87, car 9, $54.62, car 10, $35.69. The reason that this is called specific identification is because we can specifically identify each one of these cars and what it cost us to buy those cars. So I'm going to go back up here and hide that. And then I'm going to go down here. This is our total cost of sales. It cost us $31,473. Now, if you take inventory available minus the total cost of sales, we should have $18,441 of inventory available. And if you look right here, again, I hid you add those up and get down to here, and it's $18,441 matches the $49,914 minus the 6 cars that we sold, leaves you an ending inventory available of $18,441. That is specific identification. Now, again, specific identification really isn't as tricky. It just means that you can specifically identify each item you have for sale and what your cost to acquire it was. So that way you can run these costs and you know what your inventory left is. Now, we talked about the lower of cost or market earlier. This is going to come out of your textbook, page 220, example 5.9. So here we have our inventory items, which are motorcycles. We have the Roadster, we have the Spirit, we have off-road, we have the Trax 4-wheeler, and we have a Blazer. Now you'll see that we have 20 units of that, 10 units of that, 8 units of that, and 5 of that one. Now, the total cost of the historical cost of what it cost us to get the Roadster was 20 times the 8,000 makes 160. However, we can go now to the market and buy those for $7,000. So we have to do the 20 times the 7,000 gives you 140,000. If you'll notice, I have this highlighted. That means you have the lower of cost or market. The lower of cost or market is the market. We go down here to the off-road vehicle, the Trax. We have 8 of them at $5,000. $40,000 is our historical cost on it. To replace it on the market, it would cost us $52,000. So you notice we have the lower of cost or market. We're taking the cost this time, not the market. Same thing up here with the Spirit. $50,000 for the 10 of them that we bought at $5,000. It's lower than what it costs us to go to the market, so we keep the cost. We go to the Blazer. We have 5 of those at $9,000. That gives us $45,000. However, we can go to the market and replace that at $7,000. So we take that 5 times the 7,000 gives us 35,000, which, as I've noted here with the different marking, we are taking the lower of cost of market, and the lower of cost of market on this one is the market. So we've got 35,000 there. So if you add these up, our total cost to acquire these was $295. However, we could go to the lower of cost or market and replace it at $265, or keep these two and then replace them with that. So you have to take a $30,000 downward adjustment to your inventory. Cost of goods merchandise inventory is an expense account. To increase it, you debit. So you raise your cost of goods by $30,000, and the offsetting entry is you adjust inventory to lower of cost or market. You're adjusting the merchandising inventory category for $30,000 credit. And as we know, merchandise inventory is an asset, so to lower it, we have to make a credit entry. This is what it would look like to do lower of cost of market on example 5.9. I hope this has been beneficial to you. My name is Dennis Brooks. I'm a graduate student here at UAB, and I am able to be contacted through Colat Tutor Lab at uab.edu, or you can reach me, or you can arrange for a Skype session with any tutor here at Colat space tutor on Skype. Again, thank you. I hope you found this enlightening.